Hi guys. So today we're talking about a particular topic known as partnership accounting. So I'm going to teach this particular topic in a secondary school way because it's a secondary school lad that came to my inbox and he said that he wants to learn accounting like at by his level. He's still in secondary school. So I told him, don't worry, I got you covered. I will what we did, he suggested a topic on that particular day, which is this partnership accounting. And he wanted to suggest another one, manufacturing accounting. I told him no. Like when I make the video of this partnership account, then you comment what another topic that you are suggesting for another video. So, but this is not just open to like secondary school. No. So we do for both tertiary institutions too. But the thing is, I have other engagement. I'm a bit busy, so that you not think like immediately you suggest a topic that it comes like almost immediately. No, I'll just like take my time. So this is me trying to make a video on the topic partnership account. So you can equally forward this video to any secondary school person that you know. And this video will be uploaded on my YouTube channel. So I don't know how long this video is going to take because if it is in my Facebook page at the Petroleum Business Consult, I don't know how long. Depending on the length, we will actually cut it. But on our YouTube page, it will be there the same way it is based on the length. We are not going to cut it. So today we'll be treating partnership account. And I actually made this question myself. So you are definitely not going to see it anywhere. Just in case you are looking for where it's solved, where I copied it from. No, you are definitely not seeing it anywhere. I structured the question myself. So the question is Alex, David, and Ozonna entered into partnership. Below is a list of balances extracted from their record. We have the trial balance, we have sales, purchases, carriage, on purchases, we have return on sales, we have office equipment, machinery, we have land and building, we have accumulated depreciation for office equipment, we have that of machinery, we have that of land and building, then we have capital. Alex contributed 700,000, David contributed 300, Ozona contributed 300, and we have current account balances and so on. So this is the prior balance that we'll be working on. But there again, just take note, there again, we have additional information. They said these are the additional information. One said depreciation is 20% for office equipment and machinery and 10% for land and building on a straight line method. So before I continue, I will explain this. That partnership account, there are things that are unique to partnership account, which is one, the capital that is introduced, two, share of profit. What is the profit sharing ratio? Because at the end of every partnership, they have to share profits and their losses. You get two, that is share of profit. We have scenarios of current accounts. It doesn't always occur. We also have scenarios of drawing and all the rest. But the major thing is the capital introduced and the share of profit. That is the profit sharing ratio. Then we have two. Before I go to two, they said depreciation is 20% for office equipment and machinery and 10% for land and building on a straight line method. We have methods of calculating depreciation. But for this particular information, we are working on a straight line method. Straight line method is just like cost all over number of years. So if cost is 20 or 200 naira and then number of years is, let's say, like 5 years, 5 divided by 200 or 200 divided by 5, then you have about 40. Yeah, you have 40, 40 which is 40 naira as depreciation for the 5 years. That is why it's called straight line method. So, but they said depreciation is 20%. 20% is just to get the number of years using a percentage, you just have 100 divided by 20, which will give you 5, which is depreciation is 5 years for office equipment and machinery, and 10% for land and building. 10% here is 100 divided by 10, will still give you 10, which is 10 years for land and building. So on a straight line method, if you have cost less accumulated depreciation, you then have like number of years remaining for the useful life of the asset. But just to be on the safe side, cost all over number of years gives you the cost of depreciation for each year. Do you get? You just extract the one that is for that year. So where we have accumulated depreciation, you just know that the that particular asset has suffered depreciation before this current year. That is just the explanation of this accumulated depreciation. Then we have drawing during the year where goods, some partners withdrew some products or some goods from the company. Alex withdrew to the tune of, they said goods in amount, which means we have goods in units. Say, not that inventory can be calculated in units and in amount. So Alex withdraw to 150,000, Ozana on goods 50,000. Then cash, they also made a cash drawing. David withdraw 120,000, Alex withdrew 70,000. So why it is an additional information is because this particular information has not been reflected in the books of account as to this trial balance. So things that happened after the records has been extracted. That is what additional information means. We have 3 salaries amounting to 19,000 is not yet paid in the said period. Then 4 profit and losses are to be shared according to the capital contributed. So this is another unique thing about partnership. The profit and loss are to be shared according to the capital that the partners has contributed. We have 5. Mr. David took a 2-year loan amounting to 500,000. Then we have 6. Unshared profit from last financial year amounted to 246,000. So there is, from their last financial year, they have not shared the profit. It's still in the books of account of the company. So required, after all this English, what are you supposed to do? Required said, prepare statement of profit or loss for the year ended 31st December 2024. That is 1, 2. Prepare statement of financial position as at 31st December 2024, showing share of profit and current account balances of each partner. So the least I can do for you people in for secondary school is at least to use the right terminologies. Accounting is shifting its shape. So your usual balance sheet is now known as your statement of financial position, so that you just know that what we are looking at for is the balance sheet. I don't know if your school is still using statement balance sheet. You just know that that is now called statement of financial position. So here we move to sheet 2, where I've actually solved this particular question. So the first thing we'll be talking about is statement of profit or loss for the year ended 31st December 2024. So please, I want you to go through the question again. Go through the question again at your leisure and understand how these workings were made, so that even at the comment section, you can ask me any question at any time and I will be able to answer you definitely. So we have statement of profit or loss for the year ended 31st December 2024. We have sales. Sales here is 975,000. Let's check. That is it, 975,000. Then when sales is made, there was a return. So customers who returned after we've sold to them actually returned goods amounting to, that's return on sales amounting to 17,000 naira. So amounting to 17,000 naira, which means they returned back some of our goods. So it's going to actually reduce our sales. That is why you see less return on sales. Return on sales is return inward. You can see it. It's either you see return on sales or you see return inwards. When you say return inwards, it's the same thing as return on sales, because that return is coming in. When you see return outwards, it's the same thing as return on purchases. So the return is going back to the supplier. After that, we get our cost of sales. So cost of sales is gotten by purchases. You have 620,000. Our purchases here is 620,000. Then add carriage on purchases. This should be on purchases. It's an error. As it, we have it carriage on purchases here. So see, carriage on purchases, that is 85,000 naira. So when you add it, you have 705,000. You less drawings. This is also drawings. This is also drawings. So we have here these drawings. We have here carriage on purchases. So we have drawings. Drawings here is as per this second note. They said during the year, drawing was as follows. Goods in amount. So Alex took goods worth 150,000. Uzonna took goods worth 50,000 naira. So we have this particular drawings here. Alex took 150,000. Uzonna took 50,000. So we then, if you less these two, you have cost of goods available for sale. Because the partners withdrew the goods, it's no longer in the business. So we have cost of goods available for sales. This is the one that is ready to be sold, the cost of the goods that are ready to be sold. Now, less closing stock. At the end of the year, they had closing stock amounting to 235,000. Let's check our stock. We have stock here 235,000. So closing stock is 235,000. So if you deduct this, you have 270,000, which is our cost of sales. This 270 is the cost of sales. Just in case somebody gives you the question and asks you to find cost of sales, this is how you find cost of sales. Is either you call it cost of sales or you call it cost of goods sold. So when they ask you how do you find your cost of sales or cost of goods sold, this is how you do it. Less closing stock, you have cost of goods sold or cost of sales. Then the difference between the cost of sales and the total sales is the gross profit. So you can see we have our gross profit here. Then after gross profit, there might be other form of income that the company might receive. And in this case, we have discount on purchases, which is also known as discount received. We only receive discount when our suppliers give us discount. So that is why it's called discount on purchases. So our discount on purchases here is how much? I think is here. Yes, you can see discount on purchases is 6,000. So we have here 6,000. So that is this is known as the total income. I call it total income. So just so somebody asks you what's the difference between profit, income, gain, all these things. So these are the scenarios where you can find the difference, because there are some things that constitute to give what is called gross profit, which other income cannot be found. Then we have less expenses. The different expenses that we have, according to the question, has been outlined here. We are deducting them. We have printing and stationery, we have repairs and maintenance, we have office supplies, we have salaries, we have discount on sales, we have cleaning expenses, we have other office expenses, then we have depreciation. I think this particular thing should be highlighted. This is our normal. Then we have depreciation. Now the three non-current assets, which you know as fixed assets, we have in this question is office equipment, machinery, land and building. Then how do you get the current year depreciation? Remember that the additional information said that depreciation is on a straight line method, which means cost here, the cost, see, office equipment, the cost of office equipment is 400,000, and then they said depreciation of office equipment is on 20%. So even if you do 20% of 400,000, still going to give you 80,000. But just be on the safe side, so that you not just like start thinking high, because you are talking about secondary school people now. So just say 100 divide by 20, just give you 5 years. You know that the asset is going to the useful life of the asset, or the asset is going to run for a period of 5 years. So what you just do is 400,000 as cost of the asset divide by 5 will give you 80. You can see that this one already accumulated depreciation here is 80, which means this office equipment has suffered depreciation for 1 year, just 1 year. So this one that we are recognizing now here, 80, is the second time that the asset is suffering depreciation. So we have machinery here, 108,000. So machinery here is 540. So 540 divided by still 5 years, we get the we get 108,000. Then we have land and building, 82,000. 82,000. We have land and building is 820,000 divided by 10 years. So that is how you get 82,000 to 2,000. So total expenses is 620,000 naira. Let's check again. So you can see it's 620,000. So that's it. So 994,000 minus 620 will give you net profit of 74,000. So that is for the profit or loss for the year ended 31st December 2024. So we'll move to the second requirement. The second requirement that says statement of financial position. Like I said, I don't know if you have heard of, if you use balance sheet in your own side, but it's now called statement of financial position. So that is where we are heading to now. So before we go into the statement of financial position, there are some workings we need to do to ascertain information to be used on this statement of financial position. So we are heading over to the workings. So the workings are one. Working we have to do now is one. First working is that of the non-current assets. So working on non-current assets. So if you're working on non-current assets, so I'm coming, please. So we have workings on non-current assets because after Alex Davis statement of financial position at 1st December 2024, we have non-current assets. So what and what constitutes non-current assets? I just want to drag this so that we can see the two at the same time. Okay, so that I'll be explaining while having the two in the same space. So we have non-current assets. Balance brought forward. That is cost. Or you can use cost here. So I just think let's just change this to cost. Let's use cost here instead of balance brought forward. So we have cost. Cost here is 400,000. Let's add. So we have cost here 400,000. What is the cost of the assets? So you can see cost 400,000, machinery 540, land and building 820. So those are the costs: 400, 540, 820 land and building. Accumulated depreciation, like I can explain, accumulated depreciation is depreciation that the asset has suffered before the current year depreciation. So that is accumulated depreciation. And we have our accumulated depreciation to be this 80,000, 216,000, 164. So you have it 80,000, 216,000, 164. And we have our current year depreciation. So current year depreciation is just the one that we calculated in the profit or loss. Sorry. In the profit or loss, where I told you let's just see it. We have here. That is the current year depreciation. Where we just use cost of the asset divided by number of years. So that is our accumulated depreciation. Current year depreciation rather. So you have cost less depreciation, both the one of accumulated and current will give you the carrying amount. This is known as carrying amount. It's known as carrying amount of the asset. So the carrying amount of the asset is what you bring into the statement of financial position. Here, office equipment is for 240, machinery is 216, then land and machinery This is land and building, no machinery. We have land and building, which is 574,000. And we have loan to David. So in additional information 5, it said Mr. David took a 2-year loan amounting to 500,000. Why I recorded it under non-current is because they said a 2-year, which is not a loan payable within 1 year. It's like a 2-year loan. So I just recorded it under loan to Mr. David 500 as something that is not just current to the figure to that particular year. So we have total non-current asset is 1,513,000. Then we have current assets. We have stock. Have our stock to be 235,000. Stock is a non-current asset. It is the amount of goods that is still remaining at the end of the year. So that is stock. We have cash and bank. Much is cash and bank? That's it's 4,000. We have drawings. Drawings from the cash. Remember they said here we have drawings, cash drawings that David and Alex did. So we are removing it from the cash that the company has. So we have 120,000 and we have 70,000. So we have trade receivables. We have trade receivables. These trade receivables of 350. Trade receivables are those people expected to expected to pay the company that is owing the company, customers that are owing the company. That is trade receivables. That is 350. So stock plus cash minus drawings 120 minus 70,000 plus 350 will give you 1,296,000. So the summation of this will give you total assets, which is 2,799,000. And we have next is capital and liabilities. So after that, the next working we'll be talking about is percentage for share of profit. Remember in this particular additional information 4, it said profit and losses are to be shared according to capital contributed. So just according to how the partners contributed their capital, that is how they are going to share their profit. So we have our capital here. Alex contributed 700,000, David contributed 300,000, Uzoma contributed 600,000. So here we have 700 plus 300 plus 600, which is 1,600,000. Then Alex contributed 700,000 divided by 1,600,000 times 100 will give you 43.78%. So Alex is entitled to 43.75% of the profit. David, the same thing. Hosanna, the same thing. So we have this is percentage for share of profit. Then we have share of profit. Now, due to that, the question did not tell us whether there is additional or another capital introduced after last year, because of this particular additional information that said unshared profit from last financial year amounted to 246,000. So we are still maintaining that the same capital we have this year is the same capital we had in 2023. The same capital we have for 2024 is the same capital we have for 2023. If not, there would have been an additional information that will say that capital as of 2023 is so amount, which means there is an additional capital, which would have given us a different percentage to account for this 246 based on the capital they contributed. But where there is no additional information to that effect, so we are still maintaining that it's the same capital. So we are using the same percentage for share of profit to share both the current year profit of how much 74,000 and the unshared profit from the last financial year of 246,000. So what we are going to do here is total profit is 74,000 plus 246,000, which is 320,000. Then Alex, this Alex share of profit, percentage for the share of profit is 43.75%, which is 0.4375 times 320, which is the summation of the two profits. You can see Alex has 140,000, David 60,000, Ozonna is 120,000. Zona is 120,000. So I just want to explain the share of profit. Before then, let's talk about the current account. So the current account balances as per the trial balance is this: Alex 440, David 350, Ozonna 250. So you can see it's balance brought forward. That is the current account balance. It's 440, 350, 250. So during the year, there was a drawing for goods. Alex withdrew goods amounting to 150, and then Ozonna withdrew goods amounting to 50,000 cash. Alex withdrew cash of 70,000, and David 120. So you are going to deduct this drawing from their current account. Before you ask what is the difference between capital and current account, capital is the amount that partners give to the business or put together to start up this business. Current accounts are like when there is a financing to do outside the capital, business has started running. They have contributed already, but current accounts are their own personal money that they brought out to fund certain things in the organization. So it is being recorded in the partner's current account as if like the company is supposed to pay them. But here, since they introduced this current accounts and then they did drawing, they are then charging these drawings to their current account. So Alex now has a current account of 220, David 230, and then Ozonna 200. So that is why you see the current account. We have capital. Capital is still the same, nothing. Then we have current account of 220, 230, and then Ozonna 200. Then we have share of profit as we've explained this. Then if you sum total capital is this, and current account and share of profit, you have 2,570,000. There is no non-current assets. Current assets, we have unpaid salaries. We have here salaries amounting to 19,000 is yet to be paid in the set period. So 19,000 is not paid. We have 19,000 naira. We have trade payables as per the question is here. Trade payables 210. So trade payables are suppliers that supply goods that we've not paid. So 210. If you sum this, this, and this, you get 2,799,000, which is the same thing we have on the asset side. Now, like I said, this particular question, I structured it myself. So before you will not be looking for a textbook, no, don't worry. Don't stress yourself. So that is it. I don't know. For another thing is somebody might ask a question. What if there is no current account that is being given in the question where you are solving? You can deduct any of their drawing from their share of profit. So where there is no share of profit, it affects their individual capital. So see you on the next one. Like I said, this particular video will also be showing on my YouTube channel at Ago OY Mary, and also on my Facebook page, Cleopatra Business Consult. This particular video is for our secondary school students so that they will not be excluded in the videos that we make. We have them in our mind too. So see you on the next one.